Hi friends, this episode we will see about the Nifty 50 index funds. So previous episodes we have seen about the Nifty 50 index. So let me go through about it. So this Nifty 50 index is in the top 50 companies in India. So what are the stocks holding it? Reliance, HDFC Bank, ICICI, Infosys, HDFC and TCS. So it has its own weightage. Suppose you want to invest in these companies in the same proportion, then you can invest in Nifty index funds. So what is index funds? It will collect the money from you and put it in the same index constituents based on its weightage. So here I have taken UT Nifty 50 index fund. So it is the topmost index fund, passive index fund. It's managing about 9,000 crores. So we click here this overview about these funds. It's managing about 9,376 crores. The minimum investment is to start with 5,000 rupees. The minimum monthly investment amount is 500 rupees per month. So you will see about the portfolio here. It has invested in Reliance, HDFC Bank, ICICI. If you see the Reliance weightage is 10.42. Here also this 10.42, the same weightage. HDFC is 9.06. Here also 9.0. So they will mimic both these Nifty 50 and this index, these funds actually. So same proportion only they will invest in this index funds. Reliance, HDFC, ICICI Bank, whatever there in the Nifty 50 index stocks, they will invest in the same proportion in that. So fund manager will not take a call which stocks we need to allocate more, which stocks to allocate less, then which sector to invest for the future of the better returns and risk adjusted returns. Like that they will not take a call. They will just collect the money and invest in this same proportion in this index funds. So most of these index funds actually it has given a stable return based on the market conditions actually. So it is volatile also. It's not a risk free, it is volatile. So it has a very high risk. Actually you need to know the risk before any investments. It needs to know the investment. Then this lot of parameters we need to look into before any investments also. So how this returns has given in the last 1 year and this 5 years, like that you can check it here actually. This is the last 1 year return. It has given 4.18 percentage. Then last 5 years what is the return? 12 percentage. Then last 10 years what is 12.47 percentage it has written. The returns are not guaranteed because it is on the past performance. We never know the future performance, how the index going to perform. Nobody knows that actually. So then another thing you need to consider is the risk parameters. So if you see here the peer comparison actually, compared to this is passive index fund, this is an active managed fund. The fund manager will take a call and invest in these funds actually. So how they will able to contain the risk actually. If the market is going down, if your active funds goes less than the fall of the Nifty 50 index, that is a good fund. If the market is going up, then your active funds is able to beat the benchmark, then it's also good performance actually. So the fund needs to perform better in the downtrend containment also. When it's going uptrend also, it should be able to beat the index. So that is the good sign of a good funds actually. So your financial advisors, you need to know how much which is the good funds to invest for you also based on your risk appetite. It's not like rather than blindly going by the returns parameters. There are a lot of parameters in choosing the right funds for the investors also. So this we should not go by only by the returns and the star ratings. Star ratings also will change accordingly based on the performance. It will vary actually. So you need to be keep on monitoring this fund performance actually. So if you are not concerned about fund performance, I'm not bothered about, I want only the market returns, I'm not bothered about the containment of this risk also. So you can go and invest in this funds also, Nifty 50 index funds. So how this is a worst, this is the trailing period actually. This is how last past 7 years, 5 years and 10 years it has performed. This will show these returns actually. So if you see here actually the 10 years Nifty 50 index, and then this Canara Robeco blue chip fund also, it has beaten this by little margin. It has beaten 7 years track record also, 5 years, like that it able to beat in that. What are the worst and best periods also? So the worst period, the worst week returns, it has fallen 18% also. Then in bad years it has fallen about 52% also. This fund has fallen at 21% in a bad year actually. This 32%. In the best years it has given this 114 returns also. The best week also it has given 23. So this is based on the risk returns actually. So it has a risk and return, both the sides of the coins. So you need to know both actually. So what is the best time it has given good returns, worst time also. You need to know these things before making any investments in mutual funds also. So asset allocation, it will be 100% in purely in this stocks only. They will not allocate any money on the debts actually. Some of the funds has invested to safeguard this fall. So most of the times it will be 100%. This will be invested in the equities also. So holdings we have seen. Then the best and worst period also we need to consider before any investments also. You need to know the risk before the returns. You should not go by only by the returns based, because that is a parameters based on that risk adjusted returns. So this is called risk adjusted, how this fund performs based on the risk, that how much they are taking more risk to generate the return, or they are taking less risk comparatively to get the good returns. That is the full hallmark of the best funds actually. So this index funds is basically mimicking this index. Then we will see about this what is the Nifty Bs, and about these funds also. This is one of the passive index funds actually. So if you are believing that fund manager is able to beat the index, and we are able to monitor the performance, you can go for the active funds. But if you don't want to know about this which funds will perform better, and don't want to take a call, you can go to this Nifty 50 index funds also. But you need to know the risk before any investments. So this is the we'll talk about the coming session about what are these parameters also. So this will give you the some ideas about this. This is the fluctuation actually. So this is the fluctuation about this last 1 year actually. This is the fluctuation in the Nifty index. It went from last 1 year this 0% to 10% down. Then it recovered to 5%. Then again it moved above, then it comes down. So it will be very fluctuating. If you take in the last 3 years, 1 year track records, it will be fluctuating, because market is always be volatile actually. This is the corona effort. Market fallen almost from 0 to 35% that during the corona time. Then it's after that the market got recovered. Then it went up actually. It has given this steady returns, ups and downs. Then it fallen during corona time. Then it moves up actually. This is they are comparing to the large cap equity funds actually, compared to the Nifty index. This is the 10-year period. This is the 2008 fall actually. So this is from a period of almost 2000 I have taken. So it will give you the smooth idea of how this market will be fluctuating actually. So I will remove this BSE 100. So this is the fluctuation actually. So this is from 2000 started. So how the fund has performed in these periods actually. So you need to know these investments. Before the investments, how it's volatile, how it's behaving, you need to know it actually. So the investing is not simple. So you need to take care of your asset allocation, and when to take out the money, when to put the more monies in the funds. That things you need to be able to monitor the time actually. The good advisors needs to help you in guiding it properly. So this is the fluctuation. This is the 2008 market fall actually. So almost market has fallen very much risen from 2004 to 8. This is the bull market rally. Market went up actually. Then market has fallen after the 2008 collapse. Then it took more time to recover actually. Then after some time it got recovered 2014 after that fall. So you need to have that containing the risk and maintaining your asset allocation is essential for the good performance of your portfolio. So this is then a 2010 it market fall, then it recovered. Then it is a range bound market here. Almost this year it has a range bound market from 2010 to 2014. It has a range bound market here, almost here actually, from here to here, range bound market. Then it went up, then it has fallen, then went up actually here from this is the current market situation now. I hope you will get the better idea about the Nifty index fund. Thanks for watching.